Welcome back to Morning Trade Live. I'm Renita, in for Oliver Rennick, Renita Young, and we are now going to shift the conversation just briefly, and let's bring in Tammy Trenta, founder and CEO of Family Financial LLC. Tammy, thank you for joining us today. We appreciate your time, and tell us first your thoughts on what we've seen in markets this week. The S&P 500 is up just under 1% right now, week to date.
Yeah, so it's been an exciting last few weeks in the stock market, after seeing some of the performance in the second half of the year. But I think that investors are cautious about this holiday season. There's a lot of uncertainty out there right now.
Let's talk about the first half of your comment first. Yes, there's been a lot of excitement this month. Even month to date, the S&P 500 is up close to 9%, close to 9%. But do you think this is the start of a Santa Claus rally that'll actually last into the new year?
Well, that's a great question. Being Black Friday today, I think it's remaining to be seen. The retailers have been really bracing themselves this holiday season. The PPI index came out a few weeks ago showing that retailers are being cautious right now. They're not hiring as many seasonal workers. They don't want to have as much inventory. And, so it'll really be up to the consumer this season to see how robust the holiday sales are and what that looks like for the stock market going into next year.
So let's talk about that state of the consumer heading into this holiday season, because we've definitely seen data that suggests both places. It's almost like the data suggests that consumers are still able to hold up, right? But then earnings might suggest something a little bit different. And then the outlook for earnings for the next quarter and for the full year suggests a whole lot more caution, just as you said. But how would you characterize the health of the consumer right now?
That's a great question. I think that the health of the consumer is bifurcated. Have lower income earners, for example, they're starting to pull back. They're starting to become more cautious. The savings overall over the past year has eroded, and you see consumers going into credit card debt. You see higher late payments now than there's been in a very long time. So I think that the consumer is getting stretched at the lower end. And then you also have higher income earners that are still spending on things like vacations and travel and things like that during this holiday season. We did have really strong GDP numbers last quarter. So, as you know, that's a lagging indicator. But I really think this holiday season will be telling and foreshadow what will be happening next year.
You know what I find interesting? How a stock that traditionally does pretty well this time of year, i.e. Walmart, right? And even when it comes to earnings, any little crack in its earnings report, like the outlook, for instance, it sends the bears in. And so we saw that happen during the week with Walmart. What other trends are you seeing happen with some of these retail stocks as they continue to report earnings?
Well, I think it's interesting with retail stocks. A lot of people have an impression that, well, during the holiday season is when sales are strongest, and that is correct. But, we have to remember that stocks are information that we know are priced into those stocks. So I wouldn't expect a lot of movement, but companies like Target and Walmart, those are more resilient during the holiday season than maybe higher or more expensive retailer brands. So, in terms of overall spending, I think Walmart is a better buy than like a Nike.
That's a good way to put it as well. You said they're more resilient because while, Walmart did see a little bit of a hit last week, it was still relatively strong in the earnings report. But let's shift gears quickly into the inflation picture. Now, do you expect inflation to continue to fall next year and then the Fed to continue to make decisions as they are now, or are you looking for something different?
Well, the Fed is taking a very firm stance. They really do want to see inflation get under control. And we've seen a lot of positive signs this month that it's starting to temper. And so I think that that bodes well into next year because it manages expectations, and expectations, to a large extent do drive the day-to-day fluctuations of the stock market. So, when you have um, a more stable expectation with the Fed, that helps the stock market to become more stable. I think the consumer and overall investors are getting impatient because they want to see rates go down. I don't think we're going to see that for a while. And when we do, that's a signal that the stock market is not strong.
Mm.
So it's sort of a six on one, half a dozen on the other. We want low rates, but we still want strong earnings. And you can't really have both, at least in the foreseeable future.
Very well said. Now, let's talk about what your thoughts are on the stock market heading into 2024. The NASDAQ had a booming year, up year to date more than 46%. We know the S&P 500 is up as well. What are your expectations for the stock market heading into 2024?
Well, we took a strong position in the QQQs in the beginning of the year, and so that's really paid off for us. Going into next year, we're becoming a lot more cautious. So, as a firm, we're looking at debt balances with clients, getting those under control, certainly under any variable debt, margin interest, interest only mortgages. And we're taking more of a balanced and cautious approach into next year. I don't think that, I'm not looking at signs of recession. I think that, eventually we have recessions. It's a normal part of the market cycle. I don't see that happening next year. And so I think we'll still have good performance. Most people are predicting, modest growth for next year. And, I don't think that that's unreasonable. But, one thing we know about the stock market, it doesn't always do what we think it's going to do.
Right.
So at least I wouldn't be surprised either. And lastly, we are so close right now to surpassing that December 2021 high. And I think a lot of investors who, had portfolios during that period are just feeling like this recovery period has lasted way too long.
Okay, because what goes up must come down at some point. Now, talk to me briefly about the sectors you're looking at heading into the end of the year and the top of next year.
Yeah, so we replaced real estate with an energy infrastructure last year, and that was a really good payoff because real estate was down quite a bit and MLPs were up quite a bit. Going into this year, the trends I would look at is, we're still not optimistic on the real estate sector. So we're real cautious there. We're not getting into that as an asset class. I want to see the other shoe drop in the real estate market. And then, overall in the bond sector, to be honest with you, we've got, interest rates that are significantly different than they've been in many years. And so, there's a lot of talk about the 60/40 being dead. And, 60/40 is alive and well right now. So, for most investors, that's also helping them to capture additional yield. And during a period of higher inflation, but more stable inflation, bonds tend to do okay. So if we do have a stock market pullback or a correction, and we usually get 1 to 2 of those a year, we have those bonds as a buffer.
All right, Tammy Trenta, founder and CEO of Family Financial. Thank you for joining us on this Friday.